In the quarter ending March 22, Lodha Group, which is listed as Macrotech Developers, reported a strong 36% year-on-year growth in revenue. The company booked pre-sales of close to 3,460 crores. This was up by 37% on a year-on-year basis and was led by strong recovery in its key markets and segments. Residential sales, for instance, jumped 55% on a yearly basis. Higher sales from the south and central Mumbai and good growth from the suburban markets added to the overall performance. Additionally, the company has taken an average of about 6% hike in prices, adding to overall growth. Along with the growth in revenue, improving efficiencies such as cash collections were also good. The EBITDA margins dropped to 25.2% because of the cost pressure. The number is still better compared to the whole year EBITDA margins, which stand at 23%. Overall, operating margins were better in FY22, led by higher scale, cost optimization and price increase. Macrotech Developers continues to use surplus cash and cash raised through equity issue to bring down debt. Its net debt, which stood at 16,100 crores in Q4 FY21, came down to 9,300 by the end of Q4 FY22. The company now intends to use 6,000 crores of cash flow from operations in the current fiscal to bring down debt, taking its debt to equity at around 0.76 times by the end of FY23. This has helped bring down interest cost and improved credit profile. This is precisely the reason that during the quarter ending March 21, interest cost on a year-on-year basis dropped by 50%, leading to strong 72% year-on-year growth in reported net profit. This year, it also expects to repatriate surplus cash of about 1,500 crores from the UK operations as a result of improvement in business and positive outlook for the UK market. Overall, a healthy growth, improvement in margins and strong growth in operating cash would support the stock. This momentum in performance could continue as the company gears up for higher growth. Its expansion in key markets, deleveraging of balance sheet, asset monetization and a good pipeline of projects would add to growth and profitability over the next 2 years. The company is looking to launch closer to 8.7 million square feet of space in FY23, having a gross development value of close to 13,300 crores. In FY22, it booked pre-sales worth 9,000 crores, which the company is now targeting to touch 11,500 crores in FY23, a growth of over 27% on a year-on-year basis. Macrotech Developers has corrected from a high of 1538 a share in December last year to the current level of 1,040, trading below its net asset value, which is estimated in the range of about 1,350 to 1,400 a share. Even on a price-to-earnings basis at 22 times its FY24 estimated earnings, the stock is trading at reasonable valuations. For long-term investors who would like to participate in the growth in domestic real estate market, the stock offers good value. It's one of the few companies in real estate space which has capabilities, expertise, vast experience, resources and management depth which can be leveraged to sustain growth over the long term. That apart, the growth levers are in place. Its initiatives to reduce debt, monetize land bank and resolve past sticky issues related to overseas operations and SEZ would be icing on the cake.